Maverick traders. Welcome out to your trading room as we prepare for the week coming up, December 1st through the 5th. Corey here with you, and it's always fun to be here with you when I have the opportunity. We're going to go through the news of the week. We're going to talk about what sectors are heating up, which ones are cooling off, and then, of course, we're going to highlight our very best trade ideas, bullish, bearish, neutral, whatever that may be.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
To get prepared for the week ahead, let's look in the rearview mirror and see what happened this past week. Well, it was an impressive rally in markets. Each of the major indexes up huge. Strongest Thanksgiving week for the S&P 500 in over a decade. Now, it was a holiday shortened week. We had lighter volume, so they were able to push the markets. That's because a lot of people travel, a lot of people are away from the office. There's just fewer transactions. The bulls really took advantage of that. We also had a flurry of delayed data because the government had been shut down. Some of these economic news data points were just simply delayed because, well, they weren't in the office. So we're getting those trickling in. For example, we had retail sales come out. It came in as expected at 0.3 month over month. We got some delayed PPI numbers. Those came in a little weaker than expected, which is good. You want to see inflation continuing to slow. We saw retail sales worse than expected. Expected to be positive 4 was actually negative, a little plus 2.2, but a little bit negative compared to what the expectation was, and that's really a recipe for more rate cuts from the Fed. If economic data is going to continue to be weak and inflation is going to slow, well, that's a great recipe for the Fed to continue to move. So I think markets also like that as well. As we look at the markets, it was broad-based, and that's what you want to see. We had market breadth. We had all the sectors participating. The numbers were strong. Dow, S&P, NASDAQ, all higher. NASDAQ up 5, Russell 2000 up 5.5. Gold and Bitcoin both higher. As we break it down via sector, every one of these sectors was seemingly participating. So you had the S&P, it had been in a plunge. We really plunged down, you could say, towards these lows and even temporarily broke below that for a day, and then the quick and sharp recovery. This steep recovery puts us inside of a trading range for now, but it's certainly a little more bullish than bearish. You're above the moving averages. It's not uncommon for moving averages to have in a correction to kind of kiss together and then separate once again, and that seems to be what the markets are anticipating and starting to position for. If we look at the equal weight S&P, you can see just a robust rally. Again, it had plunged down, and this is important because this group really represents everything within the S&P equally and tells us that we're actually near the highs, closer than the S&P. So the other sectors that had been left behind for some time, they really picked up the pace and started to surge higher. They were coming after the weaker sectors as well as the strong, and that's what you need for a robust rally in equities going forward. The markets were led higher this week by things like Broadcom up 16% for the week, Google up over 10, Tesla up 9%, Meta, formerly known as Facebook, up 10%. It was not just those big boys either. You can see here in financials plus 5, plus 6%. You can see in healthcare it was strong. Industrials was strong. So that's what we want to see, is every one of these sectors really participating to a certain extent. Now, as we look at the week coming up, markets recovered back into that uptrend / trading range. The moving averages have started to contract, but historically we're entering into a bullish period when you think about the December period when stock markets are strong, investors don't want to sell their top performers and they don't want to have a big tax bill. What most investors are going to want to do when they've had a strong year is delay selling stock until January. That will delay their tax bill a whole extra calendar year. And so market participants tend to take advantage of that. When markets are strong, they don't fall apart at the end of the year. They actually surge further. If the S&P's up 20, it goes to 25 to 27% for the year is the typical move. So we'll see if this follows that pattern. Then one would expect some selling in early January as people want to lock in some profits on things but have now delayed that. And that's what they call the January effect. So we've got other key events. We've got PCE. We know the Fed is watching inflation closely. It's really the only thing holding them back from more interest rate cuts. We've got retail and tech stocks coming into earnings. Companies like Salesforce, Snowflake, to name a few, reporting earnings this week. As we look at the economic calendar, you can see some ISM services PMI come out on Wednesday and the core PCE. This is actually, the Fed suggests that they watch this more closely than CPI. So you do not want to see this surging higher. I think markets would not like that. It's expected to come in at 0.2, and any number around there wouldn't be a shock and a surprise to the markets. Now, we've recovered back above those moving averages. We're above the 20 a good amount. We're still flat on the moving averages and still a little choppy. So it's not a, we're still inside of the trading range. Not a robust, runaway bull market, but certainly we've got to give it the benefit of the doubt here as markets are pretty strong overall. So as we come in and look at various sectors, look at the performance this year or this week. Consumer stocks up 5, tech up 5, materials up 3.5. Every single sector higher by 1% or more. It was broad-based. And so a lot of upgrades are going to take place, of course, when you have that type of price action in terms of sector and market outlook. And so this is how trend traders work. Look, we don't want to be pushed around by volatility, but when markets are surging, we need to get on board with that. And if we look at something like utilities, you really had a little short-term trend line here, almost like a trading range. You can see where it was just zigging and zagging between those levels. And really, this week changes that story. This is the breakout of that. It's probably a bull flag. You came from up here. It's a little flag waving in the wind, and now we're breaking out to the upside. So we continue to be a little more positive on utilities overall, certainly more bullish than bearish. If we look at communication, back to the 50-day. Now, we're not at new intermediate swing highs. We haven't taken out this intermediate high. We've taken out some of the little minor pivot highs back here, but not quite as strong, not quite as robust as like utilities or something like that. And really, I'm not giving it the benefit of the doubt because although you've got above the 50, we still have more of a downward sloping action in both of the moving averages. The 20's well below the 50, and this is just not a chart where I'd really trust this. So we still think communication can be a little choppy in here and probably work its way a little lower. If there's going to be an underperforming sector, it could look something like that. Real estate, a little bit better, but some of the similar problems that we have in other sectors. Maybe this one's been in a trading range already. It wasn't really plunging. You can see at least the 20s starting to slope up a little bit more than we saw in communication, but ultimately not super strong. We called this more of a zero, and you could split hairs on it. I think it's a little bit better chart than communication stocks, but not that much. Now we turn to something like healthcare, and this is just fantastic. This is exactly what you want to see. Even when the market was going lower, it was just hanging in there every step of the way. High basing patterns and breakout, pullbacks that are being bought. Everything you want to see is in this chart. 20 above 50, both upward sloping. That is a bull market trend. Healthcare continues to be very strong. Next, we take a look at industrial stocks and some similar problems to what we saw in the other sectors. 20 below 50, recent bearish crossover, 20 downward sloping. Not a super strong chart by any means. We have this still at a -1, even though it's poking its head above there. You'd really have to say that we're still in a downward trend. We're still potentially going to set a lower swing high here and zig and zag to the downside. So not the chart that I would trust the most, being industrials. Now financials, a little bit better. Still not fantastic, but you can see how it's upward sloping here. You can see that there's perhaps going to be a reversal here within the trend and get that crossover coming and such. Financials look a little bit better. Still a zero, still a trading range, but a little bit better than some of those others. Consumer stocks, again, a little bit better maybe than some of the others, but not really strong. The 20s starting to flatten out, the 50s flat. We've kind of surged back from a plunging low, still in the process of making some lower swing highs that way. So we don't really think that this is a sector you want to jump on board with either. Still have that at a -1 as well. When you can drag those trend lines down, and we haven't taken those out, you're really not ready to be bullish just yet on that sector. Now, here, consumer staples have underperformed through most of 2025. This thing has multiple candles above the moving averages with the 20 crossing upward. We're right up here near the intermediate prior swing high, and it just looks like a sector that looks a lot better. You've got zig and zag patterns already making higher swing highs and higher swing lows. I think consumer staples can be a little bit stronger. We went +1 on this, where clearly it's a little bit, let's call it a little better than a lot of those other sectors. Not a lot better, but a little better than some of those others. Tech, where those other sectors were above their 20-period moving average, tech still below. Where they were above their 50, this is still below. And we're just starting to get a bearish cross here potentially. So that 20 within the next couple of days should cross below the 50. You're way off of the intermediate pivot high, and you're still in a downward trend with lower swing highs and lower swing lows. So tech is one of our least favorite. Now, is it a -2? Is it only a -1? That's where you could get into a little bit of a debate, but I think one of the more bearish sector charts out there. Materials, better, right? Multiple days above these moving averages, sharper breakout. Notice had already set lows down there. You could call it a double bottom pattern, which this would be the neckline, and the breakout has occurred. Materials look better than most sectors out there. We've got that at a +1 as well. And then finally, energy, where the other sectors were in downtrends. Look, the 20 still above the 50, and the 20 still upward sloping. You had a recent bull pullback, but here we go up and out of that. Energy looks really good, much, much more bullish than other sectors. The configuration, the higher swing highs and higher swing lows above these multi-week, these intermediate highs back in here and such, just looks better. So energy finally catching a bid. As we were stacking them up, no question, healthcare is the best of the best. Energy looks like the second best, and staples are just a brand new newcomer to a mildly bullish run. Technology is the lagging sector, still below its short-term moving averages, which most of these sectors just are not in that space. So quite interesting, the sector rotations we're seeing and how tech is starting to really lag in a price comparison performance case versus the other sectors. And that's what we're doing. We're looking for relative strength, relative weakness. Where do we want to position for the next few weeks and in what sectors, in what direction? So naturally, that leads us to our trades. We're going to lose 3 trades in the healthcare, the consumer services, and the consumer staples space. And that leaves us with a few trades still going where we've turned to a little bit more bullish, not a runaway bull market, but a little bit more bullish. We want to position for that, right? We're mild bulls on a broad market perspective. Well, if we're mild bulls, we want to have a category that basically is like this. A +1 rating would have a little bit more on the bullish side and a little bit less on the bearish side. Well, as we look at how we're positioned after losing the trades that we're going to lose this week, we really have 1 +1, a 0, and a couple of -1s. We need to add a little more to the bullish mix. I'm also still going to add a bear. We're going to add a -2 in tech. We're going to add a +1 in materials, a +2 in staples, and a +2 in healthcare. Healthcare being the very strongest of all sectors. So we already have an energy trade. We could have doubled down on that potentially, but those are the 4 sectors that we're going to add to the mix, and that's going to skew our portfolio a little bit more bullish, not massively, but a little bit more bullish overall. So possible trades that we can look at. Let's look at healthcare first. What we were looking at was AbbVie, and AbbVie has a little bit of a bull pullback pattern here. You can see the little hammer candle on Friday. We think it sets a higher low here and heads back towards the top of this range. If that's the case, it'll finish above 235. So what we were looking at is just a simple bull call spread. Buy the 230, sell the 235, play it as a spread. This is a +2 because both of those calls are slightly out of the money, so the stock definitely has to move in that direction. When you look at a risk graph on this, we got our plus, our minus, and our break even here. In the bull call spread, you're going to have a risk graph that's going to look like this. Meaning if the stock goes higher, in this case to 235 per share or more, you're going to flatten out up here at a nice profit. And your profit potential is larger, is greater than your risk. If the stock ends up below 230, which is this corner here, you're going to end up at a max loss, but your loss potential is less capital than what you can make. We've got a better than 1-to-1 reward risk ratio in that bull call spread. And it fits pretty well with this sector and the fact that they're coming after laggards right now. They're coming after some of those sectors and areas that have underperformed. We think AbbVie, which has been in a little pullback, it's not a major laggard, but a little pullback here recently, can move back up towards the top end of the range. That's all we need. All we need is just a little push right up into there for maximum profit. Not a big push, but a little bit of a push higher. Next, we have in the consumer staples sector, Walmart. Walmart has broken out above the intermediate resistance, that prior pivot high back there, which is a very, very strong sign of momentum. We have a +2 outlook here, the December 12th, 110, 115 bull call spread. Same thing, we just need the stock to finish above 115, which is a little bit higher, and we'll have that same risk reward where our reward potential greater than our risk. It is semi-aggressive in that it's an out of the money target, but we don't need a ton of upside. And if we look at this chart, Walmart's just surging, it's breaking out. So the momentum should be there really for some continued upside. You can see it just this past week went from 105 to 110 in the last 3 days. This is a 2-week target. A move to 115 is not a given, but we think very, very viable for this stock. With money rotating back into a lagging sector like staples, Walmart should be a beneficiary of that. As we said, we're going to add a bearish trade in tech. And our favorite is Palantir. This stock has broken a key level back here, and you can see the number of retests that it had that were broken. So this is a big, big level of support. And as we plunged below that, you can see it broke and then kind of bounced up and plunged below. Now we're in just a simple bear rally pattern. We are targeting December 19th because it's possible you get another day or two here of upside. It'd actually be nice if it just kind of gapped up to this resistance on Monday, give us an even better price, but we expect a downturn. December 19th, 167.50, 162.50. That puts us in a bear put debit spread. And similar to how we drew the risk graph in the bull call, it would be similar here. It'd be in the opposite direction though. So your break even is right here, and what we would want is for the stock to go lower. And if it goes lower, you'd hit max gain. If the stock goes higher, you would be at max loss. Higher than 167.50 would be max loser. But if it goes and finishes below 162.50, we'd be at max profit. So we have a simple bear put debit spread, not too complex, good risk to reward, where our reward potential is greater than our risk. And you can see bearish crossover here, downward sloping moving averages, all the elements you want to find for a downside trade. That Palantir chart looks really good for it. Last but not least, we got material sector. Barrick Gold has just been on a bullish run. Sometimes you just enjoy the momentum, right? This thing broke out back here and away we go. We were looking at the December 12th. Pretty simple. Buy the 41 call, sell the 43 call. That's a mild upside target, nothing too aggressive. If you look at the structure, if the stock finishes at $43 or higher, we have max gain at expiration. If it finishes below 41, we would have max loss in the trade. Again, our reward potential a little greater than our risk, and just a +1, not a super aggressive upside target in letter B, Barrick Gold. So bull market still intact. We said last week we needed a recovery this week, and that's exactly what you got. The markets were shaky, but they had the huge recovery. Buy the dips are back in play. Proper position sizing, manage your risk, all those things are critical. We're not mega bulls here, but certainly you've got the characteristics you want to see. Broadening out of the rally across various sectors. Every one of those sectors outperforming or performing at least pretty well in terms of being positive. We had outperformance in the Russell 2000, which is small caps, and that means that the widespread rally is outside of just large cap tech. That's what you want to see for markets going forward. So great price action this week in that way. Have a great week, everyone. Hope you enjoyed the trading room. We will see you next time. Goodbye, everyone.